Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and investors like you to help you get better returns in the stock market. I am here with our returning guest host, Robb Fahrion. He's the CEO and founder of Flying V, our marketing partner. And Robb, before you say a word, I just want to point out this is not a sponsored post in any way. But we had a problem on the DKI blog this week. And as usual, whenever there's a problem, Robb and the entire team at Flying V treat it like an emergency. I am speaking to you from Cebu in the Philippines. Robb and I are 16 hours apart. The problem happened over the weekend, and the guys at Flying V got on it immediately. Within one day, we had everybody back up and running. We communicated with our paying subscribers, and the messages that we got from them, instead of saying, hey, we're mad, we couldn't see posts, we had a problem, the messages we're getting were, thank you so much for your great service. Thanks for taking care of us. We basically, with Flying V and Robb and the team there, turned something that could have been a disaster into proof that we care about our subscribers and provide the best possible service. So Robb, thank you so much. Standing ovation for you. And shout out to Kashif, who was the man who got on this in the middle of the night. Thank you.
No problem. Yeah. And when Gary says as usual, he means maybe once a year, right? Once or twice a year. So not having to put out fires too often. But yeah, always good to jump on top of that. And Gary, I admire you too, kind of the way you approach your business, the way you treat your subscribers. So it really says a lot about you and just the service that DKI provides. But should we jump right into it?
Let's go.
Lot to talk about this week. We're talking big consumer spending as obviously the holiday gifts and holiday season gets in full swing. We're going to talk some NBA basketball as well in this week's 5 things. So we'll start with number 1. The American consumer rejects a recession, and it seems like they are going to spend themselves into oblivion.
Yeah, that is the way we're going. So just a week or two ago, the story on Wall Street was demand is coming down. Consumers are nearing the high end of their credit limits. I mean, we were even looking at posts on Twitter or X last night where people are using buy now, pay later for a Big Mac. I swear I'm not making this up. They're financing a Big Mac. My stock line is, yeah, I'm financing a pack of gum right now. So I've bought 5 sticks. The other 10 will come later.
Microfinancing, huh?
Yeah, exactly. But when people are financing a Big Mac, it's generally not a sign that they're flush with cash. And so just a week or two ago, the story on Wall Street was, oh no, everybody's getting a lump of coal for Christmas and the Grinch is coming, and that story was incorrect. One guy I like to read is Wolf Richter from Wolf Street. I think he does great analysis. And, Wolf has been referring to the American consumer for the last year or two as drunken sailors, right? That they just get in port and blow through their paychecks. So here's what happened. Online sales for the 5 days through Cyber Monday were up 8%. That's a big number. Now, granted, some of that's due to inflation, right? Prices are up, people are paying more. Okay, we get it, but 8% is a big number. Online sales on Cyber Monday up 10% versus last year. And let's also point out the 2022 holiday retail season was actually pretty good too. These numbers are up 8 to 10% over big numbers from last year. And the thing that was a surprise to me is in-store retail traffic was up 2%. More people are getting in their cars, going to the mall, and actually going to bricks and mortar retailers. So people are spending, and the early take on Christmas spending is the retailers are in for a pretty good season.
Interesting. You do mention too, in kind of the DKI takeaway in the email version, you talk about kind of a consumer bailout. What exactly would that look like in terms of, okay, credit card debt rampant? You talk about some sort of consumer bailout. Can you just add a little bit more clarity to that point there?
Sure, of course. So here's the potentially good scenario and then the potentially bad scenario. The good scenario is still unemployment is very low. This morning we got a JOLTS report, fancy way of saying it's a jobs report, showing that there are fewer jobs available now than people had expected. And so, the labor market is still very strong, almost 9 million jobs available. unemployment is low. People have gotten raises over the last couple of years. It hasn't kept up with inflation, but overall, the consumer has been in decent shape and they have the money to spend. That's the good scenario. Now, here's the bad one. Potentially, some of these people are nearing the limit of their credit cards, their credit limits. And, one maxim in the consumer finance sector is nobody declares bankruptcy with room left on their credit limit, right? Everybody declares bankruptcy when they've maxed out their credit line because your next step is to just use the remainder of your credit. Okay, so here's what could happen, and I'm not saying it will happen, but here's what could happen. You have a lot of people using a lot of credit. They get themselves into trouble. Non-performers spike. As we saw earlier this year, some of the banks are not necessarily prepared for these kinds of losses. These can cause bank runs, and the banks, could potentially have a problem. Now, we saw in 2008 and the spring of this year that the Federal Reserve and the Treasury Department will continue to find ways to bail out the banks. And in this case, if we have banking problems that are a result of massive consumer spending and lots of consumer distress, there's a non-crazy universe where that potential future banking bailout could be interpreted as a bailout of the consumer. And so, this isn't great thinking, but I understand why people think this way. Imagine that, you're a consumer and inflation is up and things are tight and you see these big corporations, you see the banks bailed out again and again and again. At some point, people may say, you know what? They bailed out the banks. Why not me? Right? Why do the banks get to spend and make bad decisions? Why do corporations get to spend and make bad decisions? The government backstops them. What about me? And it would be great if everyone didn't spend themselves into bankruptcy. But you know what? I can certainly understand why people might say they're bailing out everyone. Why not me?
Right. Interesting. Moving to point 2. I'm sure we all have that friend in our friend group that talks about the recession's coming, the recession's coming.
Yeah.
Point number 2. Where's our recession, Gary?
Yeah, so this has also been a sport on Wall Street for the last couple of years, right? Every Wall Street pundit, keeps predicting we're going to have a recession in the next 1 to 2 quarters. Except they've been predicting that for almost 2 years. So, where's the recession? What's going on? Okay, so first of all, we actually did have a recession. Deep Knowledge Investing did predict it, and we were right. Early last year, we had 2 quarters of negative GDP growth. Now, there is a government agency that's responsible for declaring a recession, but it's a political organization. And so they didn't want to declare a recession, and they said it didn't exist. But, I don't know what to tell you. We had 2 quarters of negative GDP growth. That's a recession, whether they decide to declare it or not. But here's the more important point. First of all, the economy isn't in awful shape. I mean, let's go back to what we were just saying. You have unemployment low, you have employment high, you have wage increases. People they're suffering with inflation, and it's very hard to buy a home right now, and car prices and financing, it's all very expensive. But in general, the American consumer is doing okay, and the drunken sailors are spending us out of the recession. But this, to me, the thing that I think is the key point, and this is what I think a lot of Wall Street is ignoring, the formula for figuring GDP growth, gross domestic product growth, includes government spending. Okay, so let's use the ridiculous example we've had. Let's say the government says, well, we don't really want to declare a recession, so we're going to take on $1 trillion of debt and monetize that, which basically means the equivalent of printing $1 trillion. And they take $500 billion, they give it to half the country, and they say, go dig holes. And then they give the other $500 billion to the other half of the country, and they say, go fill in holes. Right now, have we created any economic growth here? Have we created any value? No, of course not.
Right.
But that $1 trillion of spending actually contributes to GDP. Now, somebody might say, well, great. If we can engineer economic growth, why aren't we doing more of that? And the problem is that money that's spent it becomes debt. And that will have to be paid by our future selves, our children, our grandchildren. And as many people are starting to realize, we're going to have massive interest expense. So The interest on the US national debt just a few years ago was $400 billion, which itself is a big number. It is now ballooned to over $1 trillion a year and is rising on a monthly basis. So there are costs to creating lots of currency without associated growth. And my concern is that's actually what we're doing right now. And by we, I mean the US Congress. And I always say this, but for the partisans in the crowd, overspending is a problem for both political parties. This is not a single party issue. Democrats tend to like to spend a lot. Republicans tend to like to talk about spending restraint. But as anybody who follows politics and policy will tell you, when Republicans have control of the government, Rob, let me ask you, do they actually cut spending?
Not one bit.
No. So our position is it's a bipartisan problem. And this is an election year. So what do you think the odds are anybody's going to cut spending in an election year?
Right. Yeah, interesting. It's nice that the government has definitions that they can just decide to not use when it suits them. So that's probably going to be topic of conversation here with point 3 of how we got here. But the GDP was revised upwards. I think you just touched on some of that there in point 2, but I'm sure there's a lot more to dive into there as well.
Yeah, there are some interesting quirks to this particular point. First of all, as you just pointed out, Rob, we just explained how the GDP numbers are manipulated. The government can choose to spend, and that spending adds to GDP, whether it creates value or not. So they can basically make GDP anything they want it to be, only we get the bill down the road. The other thing that's happening is we're noticing a huge increase in revisions to government data. So first of all, the numbers are manipulated. The CPI does not give you a realistic view of inflation. We talked about this last week, right? If anybody has a grocery bill that's only up 3% in the last year, please comment, because you'd be the first person we've seen, right? The numbers,
and you and I are moving there. I think we determined as well.
Yeah, exactly. Right. We're going to move wherever you are. We're moving there going grocery
immediately.
Shopping. Exactly. Right. So the government numbers are manipulated to the point that they're fake. And, we at times have actually used the word lies. But the other thing that happens is these numbers are then later revised. And let's talk about these revisions. So first of all, let's actually, as critical as deep knowledge investing, and I personally have been about the way the government accounts for these things and the way they manipulate the numbers, let's actually take a moment and acknowledge the difficulty of this. The US economy is somewhere in the neighborhood of $30 trillion, almost 350 million people. Trying to come up with one number for inflation or producer prices or gross domestic product growth, that's very hard to do. It's hard to do on a monthly basis. These aren't numbers that you can just nail down in an Excel spreadsheet. So let's actually take a moment and have grace for the government employees who are trying to summarize these pieces of data in one number and trying to do it in a month. It's not crazy to think, oh, all right, next month we'll have a little more data, we'll get some information we didn't have, and we'll revise it. However, there are 2 things that we're noticing in this. One, the revisions have become enormous. This isn't like, 5% going to 5.05% or 5.1. The revisions for the number of jobs available, for GDP, for all of these things have become so large that there are many people in the Wall Street community, the FinTwit community, right, financial Twitter, who are actually saying, we don't care. Report whatever you want. We know you're going to revise it in a month, and the data that we're getting from you is so useless that we're not going to pay attention. This is basically the financial version of the boy who cried wolf, right? If you say enough nonsense enough times, at some point people stop paying attention. Now, there's one other weird thing in this particular piece of data. And the pattern that we've typically seen is the government likes to announce good data when everybody is paying attention. So when the initial number is announced, it tends to be really good and it gets a lot of attention. And so we tend to see, lower inflation and higher, GDP growth. We tend to get the good version of things, lots of jobs available. And then a month or two later, when there are revisions and very few people pay attention to the revisions, the real data tends, or the new data tends to be less appealing, right? And that's the pattern. Now, what was weird about this month's GDP revision is they actually revised it up. And that's pretty uncommon, to see where they announce, one set of data and then a month later to announce data that the market would consider to be more positive.
Where does the check and balance lie here? Who is checking and balancing on these entities that are reporting on these numbers? And then where does that final decision come from too, right? In terms of, okay, we're going to go with this reporting knowing that 30 days later, whatever the number might be, we maybe, if anyone found out, they'd be looking at us like we're a bunch of clowns that came up with this initial number.
Yeah, so that's a great question. And ultimately, different numbers are reported by different government agencies. So for instance, some numbers will actually come out of the US Census Bureau. Others will come out of the Bureau of Labor Statistics. The Federal Reserve announces their own data. And so depending on the data set we're looking at, there are different government sources that have the official responsibility to announce the data, and that would be considered the appropriate data. Now, two things to point out. One, the best source for a lot of this is the website for the St. Louis Fed. It actually goes by the name Fred, F-R-E-D. And if you go to their website, they have a huge amount of downloadable data and lots of data sets. And it's probably the best, most robust source of government reported data. So if you want the official numbers, that would be the place to go. And they tend to be really good about, you can read the press release and it will say, this data came from such and such an agency. The Bureau of Labor Statistics is a great example. The other thing is, there are a number of people like me where we will frequently look at the data and try to revise it and say, okay, wait, does this really look right? And, one of the things Deep Knowledge Investing did last year when the official CPI, the Consumer Price Index, which is the index that people typically refer to as the number for inflation, I'd look at it at 8-9% and say, this is ridiculous. It's 100% not accurate. And frequently it was 100% not accurate. And our estimate of monthly inflation, year-over-year inflation last year was frequently double the index. And so when it was 8%, we thought it was more like 16. And when the CPI was 9%, we thought it was more in the 18 to 20% range. And so, there are people like me and, DKI board member, Michael Shedlock, who goes by the name Mish, where, we understand this data and frequently we'll look and sort of know places where they'll hide the lies, where they'll hide the misdirection, and we'll come up with revised numbers of our own. And is anything 100% accurate? No, but we tend to have a pretty good idea that, if they're saying GDP is up more than 5%, and you look at the economy and say, we're going to take the under, right? And that's frequently how this works.
Great. That's why you're one of the good guys, right, Gary?
Well, at a minimum, what we try to do is help people make money by determining the difference between the real economy and the reported economy, right? And that's how you make money. Because remember, there's an old expression in investing that short term the market is a voting machine, long term it's a weighing machine. And what that means is short term the market will trade based on sentiment, based on the announced numbers. But long term, if you have a consumer-led economy and people don't have jobs and they aren't getting paid and inflation is crushing them, they're not going to be spending. And you can show a 5% GDP print, but that doesn't mean that people are experiencing 5% growth. And so this is, we look for the places where there are anomalies in the data and there's a discrepancy between public perception and reality, because those are the places that we can help people make money.
Right. Speaking of CPI, so market tends to focus on CPI, preferred inflation index. Fed actually prefers what is known as the PCE, Personal Consumption Expenditures Index. Point number 4 on this week's 5 things, PCE declines further.
Yeah. So, and Rob, let's go back to what you were saying a minute ago. The source for the PCE, which is again the Personal Consumption Expenditures Index, that really is hard to say.
I was a little nervous, but then I figured I'd had to clarify, and it was a mouthful.
Yeah, we're just going to call it the PCE. The source for that is the U.S. Bureau of Economic Analysis, and where you get that data is from Fred, the St. Louis Fed website. So the Federal Reserve, everybody likes to look at the CPI, the Consumer Price Index, as the measure of inflation, and the Federal Reserve looks at that, but they put more weight on the PCE. And what we saw was that the October PCE was up 3%, and the core number, which excludes food and energy, was up 3.5%. So, if you're bullish, you say, hey, great, these numbers are coming down, and indeed they are coming down. They are getting better. And what that says is that the Federal Reserve rate hikes are starting to take effect. They're starting to work and helping bring this measure of inflation down. And whether you believe the numbers are accurate or not, I think we can all agree that they are coming down from whatever level. If you're on the negative side of things, you'll point out that these numbers are still too high. The Fed target is 2%. You could say, oh, well, 3% is close. No, it's 50% away, right? And there's still work to do to bring it down. But those figures were consistent with market expectations. And as is typical for recent results, services pricing was above pricing for goods. So what we saw, and we've talked about this before, Rob, during the pandemic lockdowns, everybody was at home, so you couldn't go out and spend money at restaurants or concerts or traveling. Some people did, but most people didn't. And so they spent money on their homes. They did additions or new TVs, new media centers. A lot of people needed new home offices. Now that, the economy is reopened, people are less interested in spending money on goods, and they want to go out and experience things. And, we've talked about it before, is Taylor Swift responsible for inflation with her billion-dollar tour? And what we've seen is that people will spend massive amounts of money. They'll spend thousands of dollars on concert tickets to have a fun night out. Take a look at the cruise stocks. Those things have skyrocketed off their lows. People, they want to go out and do fun things. And so, we're seeing services pricing far above pricing for goods.
Gotcha. And I like what you said too. So you talked a little bit about the overspending, of the congressional overspending, right? Issuing continuous trillions of dollars of currency to monetize that debt. And you said this is like filling a bathtub with the drain open and wondering if you'll ever empty or overfill the tub. I got a good laugh out of that.
Yeah, thank you. So, but let's unravel that for people. Let's explain. And it was meant to be a funny line. Believe it or not, as dealing with macroeconomics isn't necessarily fun, we try to make it entertaining for people. So, what we have is this titanic fight right now between the Federal Reserve on one side and Congress and Treasury on the other. And let's talk about what everybody's trying to do. So if you're Jerome Powell and the Federal Reserve, what you desperately want to do is bring down inflation. Powell is well aware of what happened to Arthur Burns, who was the Fed chairman during the huge inflation we had in the 1970s. And Burns let up on rate hikes too soon, and we had inflation went up. He brought it down. Burns let up on the rate hikes, and inflation came roaring back. And then Burns was replaced by Paul Volcker, who ran up interest rates close to 20%. Okay. So for those of you who are realizing, oh my God, with mortgage rates at 7-8%, I can't afford a home. Try to imagine it 20%. Right. I mean, it got absolutely crazy. On top of that, with over $33 trillion in debt at the US government right now, we can't afford the interest expense on that kind of interest rate. And so Jerome Powell, who's the chairman of the Fed, is terrified of being the next Arthur Burns. He wants to be the next Volcker. He will do whatever he has to do, including put the US economy in a recession, to bring inflation down to that 2% number. That is going to be the mark of whether he's viewed as a successful Federal Reserve chairman or whether his legacy will be a disaster forever. And he's aware of that. And so what Powell is trying to do is he is desperately trying to open that bathtub drain and get the water out of the drain and bring inflation down. And that is his goal. On the other side of that, we have the US Congress. Again, it's an election year, so free candy for everybody, right? They are spending and printing and monetizing debt and running up huge, huge bills that will have to be paid by our future selves, our children, our grandchildren, and dealt with by future politicians. Right now, their goal is to get themselves elected. And so they are spending like we're already in a recession and trying to pull us out. They're going with Keynesian economic theory, which says that when the economy is tight and weak, you print currency and spend a lot, even if it's on nonsense. And so they're throwing huge amounts of money at the issue. Well, guess what that does? That increases the debt, that increases interest expense, that increases the money supply in circulation and causes inflation. So just like Powell is desperately trying to open that drain and bring inflation down, the Congress, aided by the Treasury Department, they've got the spigot open and they're saying, we don't care. We don't care about your inflation problem. We just want to get reelected. And so they are spending like crazy. And there's this titanic fight going on behind the scenes between these different government agencies that have different goals. And if there weren't so much on the line and our economy didn't matter and there weren't real lives, this would be the greatest sporting match in economic history, right? I mean, like people would be betting on it and it would be amazing to watch. And as fascinating as it is, it's also scary because these people are playing games with the greatest economy in the world. And there are 350 million people whose economic lives matter here. And I would love to see all of these people take this more seriously. Unfortunately, it's not going to happen. And so, the only thing we can do at Deep Knowledge Investing is say, it doesn't matter to us whether the market is good or bad, whether interest rates are high or low, whether inflation is high or low. It is our job, no matter what the conditions are, to help our subscribers make great returns in any conditions. And that's what we're going to do.
Great. Moving to point 5, beginning of the show, talked about NBA basketball team. Also has to do with speaking of DKI portfolio position currently, Las Vegas Sands. Point number 5, non-casino exec. You're giving me tongue twisters on this 5 things this week. Non-casino exec sells gaming stock to buy a non-controlling stake in the Dallas Mavericks NBA. I guess formerly owned by Mark Cuban.
Let's clarify. And there's a reason for the complicated, kind of funny title. So Sheldon Adelson was the legendary chairman and CEO of Las Vegas Sands. He, at one point, built it up from basically nothing into a $60 billion company, of which he owned more than half, amassing a personal fortune of more than $30 billion. Adelson was a visionary, an incredible gaming executive. He built an empire on innovation and force of will. And, every year, Inside Asian Gaming, which is a publication I respect greatly, would put him at the top of the Macau Power 50 index. Because Adelson owned more than 50% of the stock, many of his advisors asked him to sell some of it at times. And the reason is because, one, the float, meaning the shares available to be publicly traded, it was a little bit too small, and they wanted more shares available, more liquidity to attract other investors. The other thing is, when one person owns so much of a stock, it acts as an overhang. Everyone wonders, when are you going to sell? Now, Adelson, I would have been great had he sold some of his stock. To his credit, he was a huge believer in the company that he owned and ran. And the way he would pay himself was through the dividends and through the stock buybacks. Right. And the beauty of that is what he did was fair and equitable and honorable. Basically, he paid himself in a way that allowed all shareholders to participate with him in proportion to the shares that they own. He treated every one of his shareholders as if they were his own personal financial dependents, right? He treated them as well as he treated himself. And for that, we give him a ton of credit. He acted with integrity. Now, Sheldon married for a second time later in life, Miriam Adelson. Mrs. Adelson is a physician, by all counts, a very smart person. Her expertise is in medicine and philanthropy. She's been hugely effective, and every report, I've never met her, but every report I've ever read on her says that she is a smart person possessed of a sharp mind. But the issue here is that she is neither a gaming executive, a casino gaming executive, nor a basketball executive. And so she decided a week ago to lighten up on her stake in Las Vegas Sands. She sold $2 billion of Sands stock at a discount, and used that money to buy a stake in the Dallas Mavericks. Now, again, to Mrs. Adelson's credit, she realized she doesn't know how to run a basketball franchise, and Mark Cuban will continue to run the franchise. And, Cuban's pretty adept at it. He does a good job with the Mavericks. And so, that makes sense. Now, here's what happened, Rob. The market said, oh my God, Miriam Adelson, who's now the controlling shareholder, is selling $2 billion of stock at a discount, and the market panicked and sold off Las Vegas Sands stock. Our response is, one, she's not involved in operations. This isn't somebody who said, oh, company results aren't good, I want to lighten up, right? This is somebody who said, I own 56% of a gaming company, I might want to own something else as well.
Yep.
Two, there is, and I can't give a source on this because this was confidential, but there is valid speculation that this may be part of a play for Las Vegas Sands to position themselves to have an integrated resort and casino in the state of Texas. It's something that's being considered. It would give them the inside track. I don't think any decision has been made, but that may be part of the consideration there. Three, and this I think was hugely undervalued and undervalued by the market. Of that $2 billion that Mrs. Adelson sold, the company bought back $250 million of stock at a discount, and they have the cash on hand. Those shares were retired. So here's what happened. If you're a shareholder of Las Vegas Sands, you just saw $250 million of stock disappear, and they were able to do it at a discount price. This also increases the float of shares in the market. It slightly reduces by about 10% the Adelson overhang. And while the short-term impact of Mrs. Adelson's sale was negative for Las Vegas Sands stock price, the long-term impact on fundamentals is actually a positive. She did what Sheldon Adelson's advisors had wanted him to do years ago, and did it in such a way that the company was able to benefit from it.
Super interesting. And then I know with Inside Asian Gaming, mentioned them quite a bit. They reported, was it last week, that Macau gross gaming revenue up 435% versus last year, and exceeding 2019 pre-pandemic levels. So I know from speaking with you, obviously offline, still very positive sentiments towards Las Vegas Sands moving forward.
Yeah, absolutely. So two things on that. First of all, I want to thank Inside Asian Gaming. Andrew Scott and the team there, they were kind enough to invite me. I was in Manila at the time. They were kind enough to invite me to their annual party there, and I got to meet the team in person and talk with a whole bunch of gaming investors and advisors, and that was a terrific experience. It was great to be there live with them. Andrew, Jason, the rest of the team there, thanks so much for having me. Great to be there in person. But the other thing is that what we've seen, Las Vegas Sands has operations in two places. In Singapore, the Marina Bay Sands is now operating above levels where they were pre-pandemic. That facility, which is growing and expanding as we speak, is putting up numbers that were fantastic for 2019. And then Macau is rapidly proceeding toward full recovery. And so what we see in Las Vegas Sands right now is the opportunity to buy pre-pandemic performance at pandemic distressed prices. So
Right.
there's been a lot of noise in the stock lately. And, part of that has been the Adelson sale we just talked about. And part of that is, concerns. Moody's just downgraded China. We'll be talking about that more next week, I'm sure. But we're looking at this really interesting anomaly where Sands China is trading up every day in Hong Kong trading, but Las Vegas Sands has been trading down in New York trading. And what that's telling you is that Chinese investors are correctly seeing the recovery, and New York investors are concerned about the state of the Chinese economy and the Chinese consumer. I don't know that anybody's crazy or wrong. There's no criticism intended for anyone, but our take on it is we now have full recovery, pre-pandemic performance, complete with expansion in Macau and Singapore, stock buybacks, dividends, great performance, and the company is still trading at distressed prices. I love the stock right here. You might need to be a little patient. I don't know what the news is going to be next week, but if you're prepared to hold it for a couple of years, we think you're going to do really well in that. As always, please, do your own due diligence, make your own decisions. Deep Knowledge Investing, we are not providing investment advice here on YouTube. A YouTube video does not constitute a contract or investment advice. My attorneys would kill me if I didn't point that out. But I'm able to tell you what I'm doing in my portfolio. And as an individual investor, now you know why I own the stock.
Great. Thanks for that clarification, Gary. That brings us to the end of the 5 things for this week. Remember, you can subscribe for free on deepknowledgeinvesting.com. You'll receive the 5 things on Wednesday and a lot of other great insights from Gary. And if you do want to become a premium subscriber, you'll actually receive this report on the opening bell or during the opening bell Monday morning. So pretty big incentive there. Gary, any closing thoughts for this week?
No, just it was a fascinating week. I think, I already, we're 2 days into this week's trading. I already have, I think, 4 or 5 things for next week's 5 things queued up. So, we'll see if more happens later in the week, but there's already been a lot of economic news, a lot of company news. So, check us out next week, and we'll see what we're talking about then.
Thanks, Gary. And yeah, thanks everybody for watching. Be sure to subscribe if you wouldn't mind to our channel. Follow Gary on different social media, and we'll see you next week. Gary, thanks so much.
Thanks, Rob. Great speaking with you as always.